What's going on, everybody? Liam O'Reilly, Vermont economic realtor with Jerry Riley Real Estate. I hope you're doing well. Treasury yields are spiking. They're increasing drastically, and that's affecting mortgage rates with the average mortgage rate over 8% now nationally. I know about the best rate you can get here in Vermont for a conventional mortgage is around 7.75%. At least that's what Nephew has on their website. So why are treasuries increasing, and how does government spending play into all this? How does this play into the housing market? How does this affect you as a home buyer or a home seller? That's what we're going to be talking about today. But first, if you're looking to buy or sell a home in Vermont or anywhere across the country, reach out to me directly. I would love to help you with your search. And leave a comment, like, and subscribe on this video. Always appreciate the support. Let's get right into it. So here we go. This article out of Wolf Street: why longer dated treasury yields spiked. It's not magic. Yield solves all demand problems. And so we'll get right into it. Basically, um, the yields rising because the U.S. government is printing more debt, is issuing more treasuries than there are buyers available for those treasuries. So in order to find a buyer for that treasury, they need to increase the yield. They need to offer a higher return in order to attract more buyers. And if we take a look at this article, that's what they're saying right here. It's not a question of finding buyers. It's more of a question of what yield are those buyers found at. And so that's why we've seen mortgage rates, or excuse me, the US Treasury rate increase pretty drastically. And when we take a look at the issuance of new treasuries in the past 5 months since the debt ceiling crisis that took place about halfway through this year, it says here, new issuance of 1.8 trillion in 5 months needed to find buyers, and yields must rise until every last one of those securities is purchased by the public. So when they're talking about the public, what they're saying is the US Treasury securities outstanding is at 33 trillion, but 7 trillion, 7.1 trillion are held by government entities, and those are not traded. So the other 26.5 trillion are traded on the open market through exchanges. They're bought by banks or investors, bond funds, insurance companies, things like that. So when we take a look at the US Treasury's securities held by the public, this is what's happened. You can see over the past 5 months, they've drastically increased. And when we take a look at demand, at what's happening to demand for these US Treasuries, we take a look at this chart down here. We can see that demand for the Treasuries, the red line up top, are all countries, and then the top 6 financial centers. And then below, we have Japan and China. So Japan and China have dropped off a little bit, but the top 6 financial centers have increased their treasury holdings, as well as all countries around the world have invested more in treasuries than they have in the past. But even despite this net increase in treasury purchases by countries and institutions across the world, we're still printing more money and issuing more treasuries than there are people to buy those treasuries. And so basically, that's what they're saying right here. But they haven't kept up with US government debt that's been ballooning at incredible speed in recent years, with trillions whooshing by so fast they're hard to see. Okay, and so here they go into the percentage of US treasuries held by foreign investors. And they talk about how, although foreign investors are still purchasing treasuries, the amount of treasuries being issued is diminishing the percentage of treasuries that these foreign holders hold. So basically, they're not decreasing the amount of treasuries that they're purchasing, but we're printing money so fast that the overall share of treasuries being held by foreign entities is decreasing. And then on top of that, something we've talked about on this channel before is that the Federal Reserve is rolling off their treasuries. So they're not purchasing anymore. They're not adding to their balance sheet. They're just letting their treasuries mature, and the US government has to pay that off. And so when they pay off their debt, and I promise this is all going to link back to the housing market and mortgage rates, just stick with me here. When the US pays off their debt, they have to issue new debt in order to pay it off. It's like having a credit card that you can't afford to pay off with your regular income, so you go out and get another credit card to pay that credit card debt off, which, in turn makes the overall debt balloon. So they talk about it right here. Since the Fed is not buying securities to replace those maturing securities, other buyers must be enticed with higher yields to pick up the slack. And so really the that is why interest rates or the bond yields are increasing, because we're issuing so much money. The U.S. government is issuing so much money that there's the number of buyers out there can't keep up. It's not that there's nobody out there looking to buy U.S. Treasuries. It's that we're issuing way more U.S. Treasuries than we have in the past. The Fed is not a buyer in these U.S. Treasuries, so in return, the people purchasing them need a higher yield. And so, how does this affect housing? And then, what are we likely to see in the future? So, the people that invest in U.S. Treasuries, these institutions, these foreign countries, they're also buyers in mortgage-backed securities or mortgage bonds. And so, when they buy a U.S. government bond, that's considered, a safer liquid asset than a U.S. mortgage bond. Although the mortgage bonds are safe and they can be liquid, they're not as safe or as liquid as U.S. Treasuries. So, as these Treasury yields increase, as the government prints more money and they need to find buyers for them, causing the yields to increase, mortgage rates also increase. And with where government spending is heading, it doesn't seem like the US is going to stop printing money anytime in the near future. On top of all this, because the yield that they have to offer is higher than it has been in the past, the government yield on the US Treasuries is higher than it has been in the past. We have to print even more money in order to just pay the interest on the money that we're borrowing. And if we take a look at the net spending here that the US government is spending, we can see 11% of our US budget, of our government spending budget, just goes to the interest payments on these bonds. So it's kind of a self fulfilling prophecy where we print more money or we issue more debt in order to pay for our expenses. And then that debt is more expensive. So we have to issue more of it to continue to make our interest obligations on our debt payments. So that's what's going on in the overall treasury market, which is in turn causing mortgage rates to increase and mortgage rates to stay high. Now, what can we expect in the future, and how is this going to affect the housing market? Well, if the US government keeps printing more debt and the Federal Reserve doesn't step in to buy some of this debt, I think we're going to see yields stay relatively high. Now, if the Federal Reserve cuts rates, I know there's a lot of talk in the media about the Fed cutting the Fed's fund rate. When are they going to pivot? When are they going to stop keeping the Fed funds rate high? Well, I think that's only half the battle when it comes to mortgage rates and when it comes to when it comes to the U.S. Treasuries. Because even if the Federal Reserve lowers their Fed funds rate, which is the overnight rate that they pay banks for keeping reserve money in their overnight lending facility, then that's not going to necessarily those buyers, those reserves aren't going to flood into the U.S. Treasury market in order to swallow up all the treasuries that are out there. I don't think it's going to make up the excess demand. Now, it probably will affect treasury yields, probably will make yields come down somewhat, but unless the Federal Reserve steps in there and starts buying treasuries again, which is not something they're talking about, I don't think we're going to see mortgage rates come down drastically. So when we look into the future and we try to predict what's going to happen, if the US government keeps printing money like it has been, we can see mortgage rates go up from here, not down, even if the Federal Reserve cuts rates. At the very least, we could see them stabilize or not drop nearly as fast as people are expecting, even if the Fed funds rate comes down. So, what I think that means for you as a home buyer and a home seller in this market, I think as a home buyer, there's still going to be a lot less inventory on the market. Things are going to remain hard for you. It's going to be unaffordable. Affordability is very low. It could end up getting worse. And because mortgage debt is long-term fixed rate debt, sellers don't have a lot of incentive to sell their home and buy something that's less affordable. Even if the price is the same, it's less affordable because the mortgage payment is going to be much higher. So I think we're going to see sellers continue to sit on the sidelines and buyers struggle to make their payments. And I think we're really in for a long-term housing market freeze like we saw in the second half of 2023. I think we're going to see that continue throughout 2024 because people are locked into their low mortgage payments, and because of the issuance of new debt from the US government. I don't think it's likely that mortgage rates are going to get to a level that's really going to stimulate the economy unless the Federal Reserve jumps in and starts buying treasuries, which I don't think they plan on doing. At least they haven't talked about doing it. So if you're a home buyer, continue to look for the motivated seller out there, the home that's been on the market for a little while. Continue to try to find yourself a good deal. And if you're a home seller, especially over this next year, it's going to be really important to price your home accurately and be the most attractive property in your price range. Of all the, say you have a $600,000 home, you want to be the best $600,000 home on the market because there's not that many buyers out there looking, and we might see less buyers into the future. Now, I'm going to end the video here. We could talk about it, about the implications of unemployment and how that would affect government spending and the overall US Treasury market. Maybe we'll talk about that in another video. But until then, all my contact information is in the description. Feel free to reach out. If you have any real estate needs at all, whether in Vermont or in another state, don't forget to like and subscribe, and I'll see you guys in the next video. Thank you for watching.